It took Bloom Energy over 2 decades to hit their first billion-dollar year. And, well, this week they delivered a billion-dollar quarter. Welcome to Earnings Unscripted. It's July 28th, 2026, and we're looking at Bloom Energy's Q2 results, ticker BE.
Yeah, it's honestly staggering. You look at these numbers and it's pure AI urgency. Data centers aren't even asking what a kilowatt hour costs anymore. They only care about time to power.
Exactly. That whole time to token revenue concept Sridhar talked about. It's wild. Okay, so since we already spoiled the top line, I'll just add that revenue was up roughly 165% year over year.
Right, and that volume flows perfectly down the income statement. Earnings came in at 78 cents a share, so that's a huge swing upward from last year. But the thing that really struck me is the operating leverage here. When your fixed overhead absorbs that much revenue growth, margins just explode upward, especially their service margins, which finally broke into solid positive territory after years of dragging them down.
They really did, but the market reaction was completely bipolar. The stock got aggressively sold off during the regular session, and then the numbers dropped, and it spiked hard in after hours. It essentially wiped out the daily loss to finish totally flat. And watching the tape react that violently serves as a perfect reminder that our chat here is strictly a personal take, not financial advice.
Fair point. It's volatile because Wall Street's still trying to figure out if they're a legacy hardware company or a tech bottleneck. But when you see an AI firm like Nebius actually cancel their existing orders for traditional gas turbines just to switch over to Bloom's fuel cells mid-process, it tells you everything you need to know about the demand right now.
Man, walking away from sunk costs just to get power faster, that's a huge tell. But there's a weird structural quirk under all this growth, because when they talk about these massive new customer wins, they aren't necessarily selling to the data centers directly, are they?
Right, they aren't. And that's where the financial engineering actually gets really interesting. When you look at their filings, the quote-unquote customer is often literally just an institutional financier, like Brookfield. They just quietly upped their off-grid financing shelf from $5 billion to $25 billion in under a year. So Bloom sells the hardware to Brookfield's balance sheet, not the end user, completely unburdening the AI clients from massive capital expenses.
Okay, wait, I want to make sure I get this. So a data center like Nebius or whoever wants power, but they don't buy the fuel cells. Brookfield buys them and then just charges the data center a monthly utility bill for the electricity?
No, that's not quite it. It's not a standard utility model at all. The AI data center signs a long-term agreement for the capacity, but Brookfield holds the actual physical asset using these complex accounting structures. It completely redefines how they scale. Sridhar had a quote on the call. He said, "I can tell you, I never thought within 9 months we would become the standard. It just speaks to our value proposition. This is not a faster horse. This is a car."
Okay, the car analogy is pretty good. But from an analyst perspective, doesn't that make customer concentration a total nightmare to track? Because your biggest account isn't actually one client. It's just a giant pool of aggregate risk sitting at a bank.
Exactly. You're mapping bank balance sheets instead of data center demand. But there's another accounting quirk hiding in here that I find fascinating. It involves Oracle.
Oh, I saw the Oracle headline, that 55-day deployment, right? Going from first engagement to active power practically overnight. That sounded like a massive operational win.
It's a huge win, yeah. But if you dig into the first quarter 10Q, the product revenue they recognize from Oracle is mechanically depressed. They have a multi-million-dollar equity warrant agreement with them.
So, sorry, because Oracle holds warrants, Bloom basically deducts that value from the cash they get paid for the servers?
Right. It's booked as a contra-revenue line item. The base product revenue on those deals is lowered by a non-cash structural quirk, meaning the actual underlying invoice economics are better than what shows up on the top line.
That's wild. They're making more real cash than the top line suggests just because of a stock warrant rule?
Well, sort of. But then they pull a totally different lever that obscures the cash actually going out the door.
Wait, what do you mean?
They just axed their formal free cash flow guidance.
Are you serious? Why would you do that right as you hit that massive revenue milestone we just talked about?
To clean up the narrative. Simon Edwards basically reset their baseline verbally to, quote, 375 million plus for cash flow from operating activities. He dropped the free cash flow metric.
Okay, I see the sleight of hand. By focusing only on operating cash, they're hiding the capital expenditures required to build all this stuff underneath.
Yep, operating cash flow looks incredible. But if you back out the capex, which doubled sequentially to about 52 million, by the way, it paints a slightly different picture. They're reserving a huge chunk of manufacturing capacity explicitly for these time-to-power customers.
Which means they're building ahead of actual construction. And Simon Edwards actually said something about that, right? He told analysts that what used to be seasonality is now simply delivery timing based on customer readiness.
Yeah, he told them to basically throw out traditional power industry seasonal models because everything is tied to lump sum concrete pouring timelines now.
So, if revenue takes a massive unexpected dive next quarter, how on earth do investors know if demand is actually cracking or if a customer is just late pouring a concrete foundation?
They honestly won't know immediately, and that's the core risk here. Management is effectively demanding a massive amount of trust from Wall Street. They're telling analysts, if things look slow next quarter, don't panic. It's just a concrete delay.
Which takes serious nerve to ask for. But I guess when you're selling the only bypass lane to the grid, you get to dictate the terms.
Right, and they're fully leaning into that leverage because they just aggressively raised their full-year guidance. Sridhar actually had this brutal line about the utility industry on the call. He said, "Chips without power are inventory, not intelligence. Grid operators quote years. We think a 4-year backlog is not a trophy, it's a confession of constrained supply."
Oh, wow. A confession of constrained supply. He's definitely not holding back. But if they're raising guidance, what are they actually pointing to now?
They bumped the full-year non-GAAP operating income up to a midpoint of roughly $850 million, which essentially upgrades their baseline margin to about 21% going forward. That's a dramatic operational shift.
It's a totally different company now. Going from an industrial hardware play dragging negative service margins a few years ago to becoming a high-margin bottleneck for the entire AI sector. They finally found their killer use case.
Sure, but you have to keep an eye on that premium they're charging. If broader transformer supply chains ever unclog and utility delays start dropping back to normal over the next couple of years, that extreme time-to-power premium just evaporates.
Very true. They're priced for perfect execution while the window is open. Well, it's definitely going to be a fascinating narrative to follow when the next quarter drops.
Let's hope the concrete dries on time. Catch you later.
If you're having fun breaking down these quarters with us, tapping follow on your player is an easy way to catch the next episode. And, just to be totally upfront, this entire show, including our synthetic voices, is a completely AI-generated experiment, which lets us turn Bloom's billion-dollar earnings call into a podcast the very same day. We'd love to hear your feedback or ticker requests, so drop us a note at earningsunscripted@datamadness.ca or find the X link in the show notes.
Thanks for listening.